AI already knows what most stock market analysts will say tomorrow before they even say it. And in some trading rooms, humans are no longer the ones making the final call. That raises an uncomfortable question. If machines can analyze markets faster, deeper, and without emotion, what happens to human investors? By the end of this video, you'll see why the traditional stock analyst is quietly being pushed aside and what that means for your money, whether you're a casual investor or managing millions. Let's break it down. For decades, stock market analysts were the gatekeepers of financial insight. They pored over earnings reports, built financial models, met with company executives, and gave ratings like buy, hold, or sell. Investors, from institutions to everyday people, relied on their research to make decisions. But here's the thing. Analysts are human. They can only process so much information at once. They can miss things. They can be biased. They get tired. AI doesn't have those limitations. Modern AI systems can simultaneously analyze thousands of data points, including price movements, earnings changes, news headlines and economic releases, social media sentiment, and even alternative data like web traffic or satellite images. No human, or even a team of humans, can track all of that in real time, but AI can, and not just track it, understand it, compare it to decades of history, and react in milliseconds. Speed and scale. A human analyst might deeply cover 10 to 20 companies. They read reports, talk to management, and update models a few times a year. An AI system can analyze thousands of companies simultaneously. In minutes, it can read every new earnings report as soon as it's released, compare the numbers to years of past results, check how similar surprises moved the stock in the past, and scan news, filings, and even social media for extra context. It doesn't get tired. It doesn't forget to update a line in a spreadsheet. It doesn't miss subtle patterns that span hundreds of variables. By the time an analyst finishes writing a note on a company's earnings, AI has already parsed the results, repriced the risk, and in some cases, already helped execute trades based on that information. This speed isn't just a small improvement. It fundamentally changes who has the first mover advantage in the market. Emotion versus data. Markets are not purely logical. They're driven by emotion: fear, greed, panic, euphoria. Human analysts are not immune to that. They hesitate to issue sell ratings on popular stocks. They follow consensus because it feels safer. They worry more about their reputation than missing a hidden opportunity. They can get caught in narratives. The stock is a market darling. The CEO is a genius. This sector can only go up. AI doesn't feel any of this. It doesn't care if a company is famous, trendy, or loved on social media. When humans panic, AI sees changes in volatility and probability. When humans chase hype, AI sees historical patterns of bubbles and crashes. It reacts to data, not drama. Markets, at their core, are patterns of human behavior expressed in prices and volumes. AI is uniquely good at detecting patterns, even when they're too complex or too subtle for us to notice. That doesn't mean AI is always right, but it does mean it's rarely swayed by fear of being embarrassed in front of colleagues or clients. So, the question arises, who is using AI? This isn't science fiction. Some of the most sophisticated players in the market have been using AI for years. Hedge funds use machine learning models to detect tiny, short-lived patterns in prices and order flow. Banks and trading firms use AI to manage risk, automate parts of their trading, and optimize execution. Quant funds build entire portfolios based on signals discovered by algorithms, not human opinions. AI models help them spot early trend changes before they show up on mainstream news, identify mispriced assets relative to fundamentals or peers, and adjust position sizes in real time as volatility changes. Some systems even tweak their own strategies as conditions shift. For example, becoming more conservative in periods of high uncertainty, or more aggressive when patterns look clearer. Meanwhile, many retail investors are still watching TV news, scrolling through social media, or reading analyst reports that are already hours or days behind what machines have processed. The playing field is changing. Quietly, the decisions that move billions are increasingly coming from code, not conversations. What's really being replaced? Isn't replacing intelligence. It's replacing manual analysis. The parts of the job that look like downloading data into spreadsheets, cleaning and updating models by hand, running the same calculations again and again, and writing long reports that repeat what the numbers already show. Machines can now do most of that faster, cheaper, and with fewer mistakes. So the traditional analyst role, collect data, plug it into a model, and give an opinion, is no longer efficient. What remains valuable is interpretation. What does this signal really mean in the bigger picture? Judgment. When should you trust the model, and when should you override it? And strategy. How do you combine AI insights with risk management and long-term goals? The catch? You don't need as many humans to do that. A smaller team, supported by powerful AI tools, can now do the work that once required an army of analysts. The real risk. The real risk isn't just that AI replaces analysts. The deeper risk is that many investors don't realize the rules of the game have already changed. They still believe old truths like more effort equals better returns. If I just read more reports, I'll have an edge. If I watch enough news, I'll stay ahead of the market. In the AI era, that's no longer enough. The edge has shifted from individuals trying to out-research each other to systems that can process, learn, and adapt faster than any person. This creates a quiet divide. On one side, investors and institutions using AI-driven tools to guide decisions. On the other, people relying on methods that were designed for a world with less data and slower markets. The danger is subtle. You can be working harder than ever, reading, analyzing, tracking, and still slowly fall behind without understanding why. And this is only the beginning. As AI gets better at understanding markets, it also gets better at understanding people. How investors react to news, what headlines trigger fear or excitement, which patterns of behavior repeat again and again. That leads to a bigger, more unsettling question. If AI can predict human behavior, what happens when it starts shaping that behavior? In the next video, we'll look at how AI doesn't just react to markets, but can subtly influence them, from algorithmic trading to recommendation systems that nudge what investors see and believe. If you want to stay ahead of that shift, instead of being quietly left behind by it, make sure you subscribe to FinAIVerse and turn on notifications. This is where we decode the future of money, markets, and AI before it becomes obvious to everyone else.